As an investor, we always look at companies' growth, profits, or even future potential. But if there is one silent driver that moves stock prices massively, then it is valuation. You might have heard the term PE re-rating or de-rating. But what do they actually mean? And how can they make or break your returns, even if the business is doing well? So recently I covered this concept of PE re-rating or de-rating in my weekly video series in a super simple way, using two real-world examples, CDSL and Tata Elxsi. Both are fundamentally strong companies. Yet, one saw a massive rally in last 1 to 2 years and the other is seeing price correction. And the key reason is valuation shift. So if you want to understand how the market rewards or penalizes a stock beyond just earnings, this video will make it crystal clear. And if you are a long-term investor, this might be one of the most useful learning in your investment journey. Alright, let's watch this 15-minute clip from one of my weekly video series. PE de-rating and re-rating. Right, this is very interesting. Let's first understand the concept and then we'll take an example just to understand it, and then we'll take two case studies, real world example that would give you a very fair idea. Now, what is PE re-rating? I'm sure you would have heard about this term, re-rating, de-rating, right? So re-rating is nothing but PE expansion. Very simple, if PE moves from a 30 to 20 to 30, it's a re-rating, right? If it moves from 30 to 20, it's de-rating, right? So if PE is increasing, it is re-rating. Now, so very simple, when market becomes more optimistic about company's future prospect, investors are willing to pay a higher price for each 1 rupee of earning. P is nothing but how much money you are paying for 1 rupee of earning. If P is 20, which means for 1 rupee of earning, you are paying 20 rupee, right, for that company. So if P increases, it means investors are willing to pay higher price, right? Now, what are the reasons for PE re-rating? That is very important. One of the reason is improved business outlook. So let's say company has launched new products, company has got a new management which is doing better things, or let's say company has entered into high growth sectors. So essentially all these examples eventually leads to your earning growth, right? So that is one reason. If the business outlook is improved, earning growth is looking better, then there is a good scope of PE re-rating. Second is obviously improved profitability metric. If the ROE and ROC is increasing, then obviously there's a scope of PE re-rating. Then you have reduction in risk. See, every business faces risk, right? It could be debt reduction, regulatory clarity. So for example, RBI keep on tightening norms or releasing the certain norms on banking and financial sector. Basically, it has got the lever to do that. So when RBI take things easy, your regulatory risk reduces, right? So just giving an example. So basically, if the risk increases, then it results in your valuation or rather PE de-rating. But if the risk eases out, it results in your expansion or your re-rating, right? And then fourth reason could be your industry tailwind. For example, government push. We have seen with capex and infra, government pushed these sectors, government invested a lot of money, that eventually resulted in your improved business outlook, that eventually resulted in increase in earning, and hence we have seen a massive PE re-rating in a lot of PSU stocks, defense stocks, railway stocks, cap goods stocks during this 2021 to 24 period, right? So this is basically an example of PE expansion or PE re-rating. Then what is PE de-rating? It is nothing but PE contraction, where let's say if a PE moves from 35 to 20, it is called de-rating, right? So it's very simple. If market becomes less confidence in the company or sector, it assign a lower multiple to the same earning, reducing the stock price. Now, what could be the reason for PE de-rating? First is slowing earning growth, right? So let's say past growth rates have, if they are not able to sustain, one of the great example today is your IT sector. Now I'll give you a few more examples of PE re-rating. One great example is chemical sector stocks during COVID time. We have seen the massive re-rating in your chemical companies because the earnings expanded big time, right? Then another example could be IT and pharma. There was a massive re-rating that happened during COVID. Now what has happened at this point in time, IT sector is going through your de-rating phase. Likewise, your chemical sector after massive growth in last 2 years has gone through a massive de-rating phase, right? So what is the reason? IT sector currently facing slowdown in earning. There are a lot of uncertainties, risks are very high. AI is a big threat, right? We have got the result of TCS, we will anyways discuss. Then chemical sector is going through 2 years of derating. Why? China started dumping their chemicals and the earnings fell down, right? So that's first thing, slowing growth. Second is there could be sector specific issues. Like we have seen IT, we have discussed this entire sector specific problem. Regulation could be an issue. We have seen with how RBI regulate your NBFC sector, and that result in PE re-rating and derating. Competition, a great example is Asian Paint, right? Earlier Asian Paint used to command very high PE, but it has derated big time because of competition, new entry of Grasim. Likewise, your another example could be your FMCG sector stocks, like after the entry, or let's say for example Avenue Supermart, after the entry of quick commerce, there's a derating in Avenue Supermart also, right? So competition could be one. Then there could be disruption like AI. I mean, I won't say it is a complete disruption, but still it is impacting, right? So these are, if there is a sector specific issues, it could result in derating. Then management concern, right? If there's a poor capital allocation governance issue, it results in capital PE derating. And then another factor is macro challenges. If like rising interest rate or geopolitical risk, right? The currently what we are going through, that also result in PE derating. And another fifth point is overvaluation correction. So if the stock ran up too much and if the valuations are ahead of fundamental, right? Then obviously there's a scope for PE derating. Now let's take an example to understand this concept. First, let's take a very simple example. So let's say there's a company where year one, it has done a profit of 100 crore. Okay, and let's say there are 3.5 crore shares with the company, which means the earning per share is what? 100 divided by 3.5, which is 28.6. So this is 28.6 rupee earning per share. Now let's assume market is giving a PE of 20 to this company. Okay, so what will be the stock price? Nothing but your EPS multiplied by PE ratio. I hope it makes sense. So PE is nothing but your price divided by EPS, right? So if you want to calculate stock price, you have to multiply PE and EPS. Very simple math, right? So what I've done is multiplied these two things and we have got the stock price. So stock price year one is 571 rupee. Next year what happened is company's net profits have grown from 100 to 150 crore, which means 50% increase in earnings, right? Now your total shares are same 3.5 crore. So EPS has become 42.9. And now what is done is market says that since the company is growing its earning at a fast rate, market is now valuing it. It has got a re-rating from 20 PE multiple to 35 PE multiple, and stock has become 1500. Now look at this. Although the earnings have grown by 50%, but since your PE has got re-rated from 20 to 35, stock has jumped by 162.5%. Right? And year 3, let's say from 150 the earning falls to 120 crore, which means there's a fall in earning by 20%. Obviously markets are volatile and you will see ups and downs. So if let's say the earning falls by 20%, then EPS now become 34.3, and PE, let's say obviously when the earnings fall by 20%, market do not want to pay such high 35 PE multiple. So let's say market says now we'll pay a PE of 25. Right? Then what happens? Stock price becomes 857. So although the earnings have fallen by 20%, stock has fallen by 42%. And that is the reason I say that PE ratio is nothing but perception ratio. How market perceive, because everyone asks me what is the right PE we should pay for this company. At the end of the day, it's the collective intelligence of the market that decide what is the PE they want to pay. But then a lot of factors influence that decision. That's what we have discussed for both PE re-rating and derating. So PE is nothing but a perception, right? And I'll take 2 case studies to help you understand. This is, by the way, real world case study. Very interesting one. And anyways, at the end of this exercise, I'll tell you which company is this. Maybe by the time you can guess. So this is the data of this company from March 14. And this is the net profit. In 14, the net profit was 75 crore. It grown to 102.9 crore. Then 154 crore, 174, 240 crore, 290, 256, 368, 549, 755, 792 and 809 crore. Right? So this is the net profit growth. Now what has happened is in 15 it has grown by 37%, 16 grown by 50%, 17 it grown by just 12.9%, 18 again 37, 19 20%, in 20 it has degrown by 11%, right, from 290 to 256, 21 massive earning growth, 43%, 22 again 49% earning growth. Then what happened? Growth slowed down, right? Now look at what has happened. So this is the EPS of this company, okay? And again, EPS you can either calculate or you can get the data directly. Now what I've done is I've identified the PE ratio. Again, PE ratio changes every single day, but I've taken point in time data. So March 16, when its EPS was 24.9, its P ratio was in the range of 39.40. So at that time this company was trading at rupees 970 to 1000 rupee. Okay, this was the stock price in 16. 17, what happened? Although the earning grew by 12.9%, market derated this stock from 39 PE to 28 PE. Could be sentiment, could be, of course, the earning growth also fell down from 50% to 12.9. So market derated it from 39 to 28. What happened? Because of that, although earning grew by 12.9, its actually stock price fell down by 19%. Right? 18, what happened? Market kept the P ratio at 28, so no degrowth. But since the earning grew by 37%, net its stock price also grew by 37%. In 19, what happened? PE actually got derated further. It from 28, it fell down to 20 PE, and although earning grew by 20%, net because there was derating, its stock price fell down by 13%. And that point in time, it was at 932. So if you look at it net in 3 years, no change in share price. Now, I mean, at this point in time, obviously, a lot of people would have lost hope and they would have sold it, because obviously in 3 years, if you are not getting any return, you would not have the patience, right? But then what happened? Crazy. So again in 20, something absolute crazy happened. Earning fell down further and P got derated from 20 to 15. And now the share price was 616. So 4 years, your share price is down from 971 to 600. Just imagine if you had invested at 971, would you have the guts to hold this company when the share price after 4 years is at 616 rupee? I am sure more than 90% people would exit out of it. But then what happened? 21, earning grew by 43%, and then look at the magic. PE ratio got re-rated from 15 to 50. Absolute crazy, because of which your stock price zoomed from 616 to 2,955. So basically it grew by 379%, right? Then what happened? Your PE ratio further got re-rated from 50 to 109, right? Why did that happen? Multiple reasons. One of the biggest reason is exponential growth in earning. That was one. Second, we were in the middle of a massive bull rally, right? And because of which valuation zoomed to 109 PE multiple and share price touched highs of 9,600. Just imagine from 616 in 2 years, share price zoomed by nearly 15 times, right? And then what happened? Earnings started going down and PE started getting derated, right? And as a result, from 109 to 50, 60, 36. Today it is at 36 PE multiple, and as a result, its share price is now 4,600 rupee. And what has happened is, so again, I hope you got the idea, right? So earning fell down and the stock got derated. As a result, your share price fell down by 50%, right? Now net if you look at it, since 2016, if you just ignore this volatility, the EPS of this company has grown by 20%. And in that same time period, the stock price also has grown by 19%. So in the long run, market always is efficient, because net the EPS growth and stock price growth should go hand in hand, obviously, right? So market in the long run is efficient, but in the short term, it is extremely inefficient because of the sentiments of fear and greed. And this is a beautiful example of how stock price volatility happened because of change in earning growth, and mainly because of this PE derating and re-rating. By the way, I'm not sure how many of you are able to guess it, but the company is Tata Elxsi. Okay, you can check this data, and although today's screener is somehow down, so I'm not able to show you. I got this data from TradingView, I think. Ticker tape and TradingView, that's what I've used to get the data, right? So I hope it makes sense. Let's take another case study. So this company, this is the net profit growth, 41 crore, 45 crore, 76, 69, 77, right? So there was a phase in 16 when the earning grew by 68%, then it degrew by 11%, then 14% growth, then 8% growth. minus 8% growth, then look at the massive growth of 107% in earning, 67%, then again degrowth of 3%, again growth of 33%, growth of 31%. As a result, the market also kept on derating or re-rating this stock. So during this time when the earning fell down, market derated it from 31 to 19 PE multiple, because of which although the earnings were growing but not much, the stock price was range bound, right? 63, 98, 104, 96. But then during 21, earning grew by more than 100% and stock got re-rated from 19 to 38. And as a result, the stock price zoomed from 96 rupee to 364, which is 277% jump. Then what happened? 22, again 64% earning growth, again further stock PE re-rating. Right? As a result, stock further grew. So 96 to 818. Why? Because at this point in time, it was at very low PE multiple. At this point in time, valuation become very expensive. What are the reasons? Again, same reasons: earning exponential growth and massive bull rally. Right? So your stock price zoomed exponentially. But then what happened? In 23, earning fell down by 3%. Stock got derated from 55 to 32. As a result, there was nearly 50% correction in stock price. Right? Although earning did not fall, but then the stock price, your P got derated significantly. It got derated, and because of it, stock price fell down by 50%. Next year, again consistent growth year on year, and again this 24, your P got re-rated to 55, and then got derated to 43, and because of which it zoomed from 422 to 1100, and now it is at same levels of 1100. So if you look at EPS growth in 2017, since 2017, it has compounded at 37%. And since 2017, the stock price is compounded at 43%. Right? But then during this phase, let's say you invested at this particular level, today you would not be sitting on any further return. Right? Because you invested at a peak of the bull run, peak of the earning, and today, even in 2-3 years, there's not much growth. But then what if you invested at this level in 20 when the stock was at 19, when the sentiments were negative? You would be sitting on massive profit, right? Even today, because even though there's a lot of volatility, even today you would be sitting on 10 times profit. Which company is this? This is CDSL. So I hope you got an idea of what is PE re-rating and what is de-rating and what factors influence this. So I hope this video would give you a good clarity behind why some stocks grow multiple times while some struggle to perform. It's not just about earning growth, it's also about the perception. That is what PE market would pay to a company. After a massive re-rating, today CDSL is trading at a PE of more than 60, which is very high. That's where I don't see much scope for PE re-rating. In fact, any underperformance in near future can result in PE de-rating. On the other side, Tata Elxsi, even after 40-45% correction from peak, is trading at a PE of around 50, which is still much higher as compared to its earning growth. So I don't see much scope for valuation re-rating. The best time for investment was during COVID, when valuations were very cheap. But after a massive rally in last 3-4 years, today majority of fundamentally strong companies with high growth potential are trading at premium valuation with very less scope for PE re-rating. And that's one of the key challenge with investment in current market. Having said this, a fundamentally strong company, if goes through a difficult phase and witness PE de-rating, it can actually create a good investment opportunity for long term, because when the earnings eventually improve, it would result in PE re-rating. But it can also test your patience level. One such sector is FMCG and consumer durable that has struggled for a long time due to high inflation that impacted their margins and also impacted the volume growth that eventually resulted in slowdown in earning and PE de-rating. However, considering the good monsoon, government and RBI focus on consumption with tax rate cut and interest rate cuts, I expect FMCG and consumer durable companies to do well in FY26 after 2-3 years of underperformance. And that can be a good trigger for valuation re-rating. So this is it for this video. I hope you will find it insightful. If yes, do share it within your circle and let me know in the comments which company do you think are right contender for PE re-rating as well as de-rating. I'll see you next video. Till then, take care.